Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. And today we're going to be doing an analysis of another uranium stock, and this time it's Denison Mines. Before we get started, standard disclaimer, none of this is investing advice. Do your own due diligence, and I own shares in Denison Mines. Denison has a market cap of 1.3 billion Canadian dollars, trades on the TSX in Canada and on the NYSE American in the United States. Should be noted that all figures in this video will be in Canadian dollars unless otherwise noted. So there is a lot to unpack here with Denison Mines, but the first thing I want to focus on is Wheeler River, which is of course their main asset, where they have two deposits: Phoenix, which is being developed as an ISR mine, and Griffin, which is more of a traditional underground mine. And combined, they have a 14-year mine life and around 109 million pounds of probable uranium reserves. There is a pre-feasibility study already done, which we're going to be diving into, but it should be noted that they are in the process of putting together a full feasibility study for the Phoenix deposit specifically, and I believe that should be out this year. But let's dive into the PFS for now. The Phoenix deposit has an all-in cost of production of $11.57 a pound, with an average grade of 19% U3O8, which is insane compared to the world. I've mentioned before the world average uranium quality. The Athabasca Basin has some of the highest grades on the planet. For the Griffin deposit, you've got an all-in cost of production of $29.67 a pound and a grade of 1.7% U3O8, which seems small, but it's actually higher than the world average, I believe, as well. And certainly sufficient. So both are looking very good. And keep in mind, of course, again, those costs are in Canadian dollars. So as we get into the net present value and internal rate of return, just a note on the way that they've done the base case for the pricing of uranium in this pre-feasibility study. Phoenix uses a base case of $29 a pound, a sliding scale up to $45 a pound US dollars, whereas the Griffin deposit uses a straight $50 a pound base case, and I believe all of that is taken into account when we come up with these numbers. For the Wheeler River property, the after-tax net present value at an 8% discount rate is $756 million, and the after-tax internal rate of return is 32.7%. These are very robust numbers, and if we bring the base case to $65 a pound, we get an after-tax NPV of $1.5 billion and an IRR of 55.7%. Excellent, robust economics for this property. I think $65 a pound, of course, is inevitable and certainly likely to occur before the time that Denison Mine brings, I believe Phoenix is set to come online first. I think before that happens, we're going to see at least $65 a pound. So that's kind of my own personal base case when I'm looking at these numbers. So this pre-feasibility study was done in September of 2018, which is a little old for my liking. Some of these numbers are obviously going to be adjusted due to inflation, the increase in costs for everything involved in building out these mines. Now, the Phoenix deposit is an ISR, in situ recovery mining operation. This is something that has not yet been done in the Athabasca Basin, so it would be a first. I'm not a mining engineer nor a geologist, but I do know that this particular method of ISR is a newer, more innovative, more effective method. However, that of course can raise concerns when you're thinking about using a new mining methodology in a new area, the engineering challenges that could present. However, they have done de-risking by performing a series of field tests that by all accounts have gone very well. So there were tests done in 2019 and 2020 to demonstrate proof of concept. There was core leach testing that consistently produced a uranium-bearing solution, and a 2021 field test of a commercial scale ISR test pattern, which further solidified the effectiveness of this ISR method being employed. All of this is great news. Of course, it's a different story when you actually get out there and start beginning commercial scale production, but these all point in a bullish direction. So besides Wheeler River with the Phoenix and the Griffin deposit, there's a lot more, but there's also Waterbury Lake, which is another ISR operation. It's a smaller project. It's just 9.7 million pounds of uranium in total projected to be mined. The all-in cost of production is $33 a pound, Canadian dollars, and using a base case of $54 USD for the per pound of uranium, we get a pre-tax NPV of 177 million and 39% IRR. This is all from a preliminary economic assessment that was done. I'm not sure on the after-tax numbers for this. I think those should always be front and center, but in the press release where they discussed the PEA, I could not find them. Nonetheless, I think this the CEO, David Cates, has spoken about the fact that this property, although smaller, although producing a smaller amount, although the numbers aren't as robust and perhaps attractive as the Wheeler River property, it is an important asset for them and can provide a great source of revenue as well. So all of that's great, but when it comes to Denison Mines, there is so much more. Awesome to see the pre-feasibility study for Wheeler River presenting such excellent economics. We've got a PEA for the Waterbury Lake ISR project, but we haven't talked about the McLean Lake Mill. This is a state-of-the-art uranium mill that produces over 11% of the global supply of uranium, and Denison Mines owns 22.5% of it in a partnership with Orano, who owns the rest. And Orano is one of the largest uranium companies in the world from France. So that is great. There's also a property very close by to that mill, again owned by Orano, but Denison has a 22.5% ownership stake, and they're planning to use something called the Sabre mining method there, surface access borehole resource extraction. Again, not a mining engineer, but sounds promising, and its proximity to the mill is obviously a major upside because it's easy to transport ore from the mine to the mill. So in addition to this, Denison fully owns or has an ownership stake in over 30 other projects in the Athabasca Basin. I do want to bring up here that the majority of everything they're doing is on the eastern side of the Athabasca Basin, which has excellent infrastructure, roads, electricity, all of those things that you want to see. So just take a look at this list, and I want to thank Triangle Investor on Twitter who posted this. Look at the size of these properties and the quality of these JV partners. You've got Orano, Cameco, Uranium One. These are the biggest uranium companies in the world. There's a ton of potential here and the potential for some of these projects to get spun out into new companies. So huge potential, something that flies under the radar for most people who are taking a look at Denison Mines, but I think this is something that should be considered when valuing the company. So Denison also has 2.5 million pounds of physical uranium on the books, which I think is excellent. I love that. They purchased it for around $30 a pound US dollars on average. And obviously the price is much higher now, and I believe will continue to go higher over the next few years. It can be used as collateral for financing. It really strengthens the balance sheet. And I like physical uranium as opposed to cash at this point, again, because of the fact that cash gets eaten away by inflation, whereas physical uranium, in my opinion, will only appreciate over time. And speaking of cash, they have $65 million Canadian on the balance sheet, and my favorite metric, zero debt, which I always love to see. They also have $19 million worth of investments into other uranium companies, including GovEx in Africa and Sky Harbor, which is another uranium company in the Athabasca Basin. So let's get on to some things I don't like, some bearish factors. And number one, which sticks out like a sore thumb, is the share structure. It's awful. I've spoken to other investors who are much smarter than me, and they also think it is absolutely awful. It is a kind of a sticking point for some people that prevents them from investing in the company. Fully diluted, there's 890 million shares outstanding. This is for a company with a market cap of $1.3 billion. Just to contrast, let's compare that to Global Atomic, which is known for having a tighter, more disciplined share structure. I've covered that before, by the way. You can click the link above to watch my analysis of Global Atomic. But they have 195 million shares fully diluted for a market cap of $538 million. So that's more what we want to see. I think Denison needs to do some buybacks at this point, or consolidate the shares in some other manner, because it's bordering on completely unacceptable. and it is preventing some people from investing in the company and potentially some institutional investment as well. Now, we've also got what I mentioned earlier, the fact that they're attempting a newer method of in situ recovery in an area where it's never been done before, the engineering challenges that could face. I know that I spoke earlier about the tests they did, which are very, very positive and looking like things are going to work out. But as we know, same thing with pre-feasibility studies, feasibility studies. These are all just estimates of what will actually occur once production begins. The same with these tests. It's great that they were able to do some small test runs, but they could still run into challenges that were unforeseen when they do actually start the operation at Phoenix. So we'll have to see how that works out. That's something to keep an eye on. Now, the other thing, I suppose this could also be up there with share structure for some people, is a laughable insider ownership percentage. According to Simply Wall Street, it's around 0.5%, which is another sticking point for a lot of investors that prevent them from deploying their cash into Denison Mines. What's up with a 0.5% insider ownership? That's nonsensical. I mean, I can't think of why they wouldn't have more skin in the game than they do. I think if the company really steps up and management starts purchasing shares, then that's going to be very positive for the future of the company. So that's another issue. Really low insider ownership. So David Cates and the rest of the management at Denison, put your money where your mouth is. Let's go. All right, guys, that's it for today's episode. If there's something you think I missed about Denison Mines on both the bearish and the bullish side, whether good or bad, please do leave that in the comments below. It would help me out a lot and help other investors out in doing their own due diligence. And I'll see you guys next time. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.